Hey everyone, welcome back to another podcast. Today we have a special guest, my friend Mathew Owens. Mathew manages over $75 million in assets, some as a debt fund, some as an equity fund. He's done over 700 flips, and he's doing quite well through his entire journey of real estate. He's a licensed CPA living in California, and today we're going to be talking about, is it better to buy a single family to start, multifamily, and what kind of things do you need to be thinking about as you do buy these purchases and you evaluate these deals. So looking forward to seeing you there. Before we get started, be sure to subscribe. Again, all my subscribers do get access to off-market deals, reports, and then exclusive events only that I offer to my subscribers. And usually we do these events, once a year or so. So look forward to seeing you there, and we'll talk soon. Thanks. All right, everyone. I have with me today a special guest and a friend. His name is Mathew Owens. He's quite the savvy real estate investor, managing funds, dealing with international investors from Japan and other countries. And he himself has a portfolio of properties. So with further ado, Mathew, how you doing?
I'm doing great, man. Thanks for having me. I appreciate it.
Yeah, appreciate your time as well. So for the audience, if you don't mind giving us a minute or two of what you're up to and kind of your journey to where you are
Awesome.
today.
I'm having fun in real estate like we all are. We're just talking about dealing with real estate problems and things like that, right? So that's really what you do as a real estate investor, is you just solve problems. So it's a lot of fun, but you learn new things, and it's stressful in a minute, but then you get past that and you realize, wow, like I just learned a lot going through that process, So, so far, just to give you guys a little background, I'm a California licensed CPA, trying to find a way out of California for the taxes. But at the same time, I quit my CPA firm job in 2006 when I was doing audit and taxation and things like that. Previous to this, mostly for real estate related firms and that stuff. So I got to see the inner workings of their books and their financials and all of that kind of stuff is associated with real estate. And then I quit in 2006. So I was a real estate genius for about a year and a half before I lost my front teeth and got knocked out, and lost everything. But you learn the hard way, but it was probably honestly the best thing that ever happened to me, because it taught me how to raise money. It knocked my ego to the ground when all of a sudden we were flipping houses and I thought I was dope. And I'm like, no, it was just the market. It wasn't me, So, and then, since then we've flipped 700 houses. We flip 5 to 10 a month right now. We have a lot of capital lent out to different flippers all across the country. We have a debt fund set up that we do that with. And we also do a lot of value add multifamily properties. We're just finishing up one right now that's an 18 unit in Little Rock that we're finishing. We bought for $400,000 and turned it from 15 to 18 units. We've done a lot of those, and we're continuing to do those. I also invest in a lot of outside syndicated investments, which are basically managed opportunities from other outside operators and things like that, and do the due diligence on those types of companies to invest myself, as well as help other investors invest in those types of opportunities as well. So it's a lot of fun. We also do some short-term rentals. I'm getting into some tiny homes. There's some really cool stuff going on right now. It's just really a matter of setting up your teams to have the right reliable team members to get you the right information, because after flipping 700 houses, I know how to lose money on a house. So you got to make sure.
That's a great line. Yeah, that's a great line.
You realize very quickly that it's very important to keep your ducks in a row and keep everything, meticulous, and looking at your timing on everything. And most importantly, funds control. On the lending perspective, the number one risk to me is people running out of money. So, or going over budget on a contract, and then AKA running out of money, that type of stuff. And so it's a lot of fun. I've been doing it for a long time. I also run a nonprofit organization called For Investors by Investors, where we teach financial education and real estate education without a sales pitch. So we don't have boot camps or book and tape sets. It's really like a real estate investment club where we just teach. And it's really valuable. We've been doing it since 2008 and have over 25,000 members now. You can find us on forinvestorsbyinvestors.org. And it's just, it's a great way to develop resources and meet tons of people in this business, So that's really what this whole thing is about, is bringing resources to each other so we can make money together, right?
Yeah, that's right. Yeah, you hit on a number of points there. And the first one I'll say is whenever I coach my clients on looking at a deal for private money lending, I have a snapshot of what they'll make and their profits and all that. But equally, I have the snapshot of the borrower. What's the borrower going to make in the deal? And on top of that, just from a holdings perspective, if in the worst case they don't have the ability to sell the property, can they rent it in cash flow, right? Because so I measure things in there like cash burn risk, right? If they're paying out of pocket in the red every month, they're probably not going to want to hold the property. If they don't make a huge amount of profit, they might just walk away from the property. And so all these things goes into our, what I call like this deal risk score. But I think you're spot on that having a quality team that you can trust, that are good at communication, that are organized, that's definitely a win-win scenario, right? And I'll tell you an example. One of our teams in Cleveland, one of the guys is his name's Lewis, right? And he's this Peruvian guy. He's a seventh child, and his mother, obviously had 7 kids. She's a doctor, right? She's this hardworking woman, 7 kids. He's the youngest. And when I first met him, I walked into his house, and on his living room wall, he had this huge whiteboard. And the whiteboard had all these random titles or addresses. And underneath every address, every meticulous note possible with every number, net profit. And I was like, this is amazing. like this guy was essentially a doctor working within real estate. And that level of detail is why he has not yet had a failed project yet.
That's amazing. That's unbelievable. To not have a failed project is crazy, depending on how long they've been doing it and things like that, right? And but the attention to your key performance indicators and managing your investments, I think it's probably the biggest problem in the industry with most real estate investors is they don't know how to manage their money in the first place, let alone manage their investments. And so it's so key to focus on that personal financial situation aspect and track, hey, what is this investment doing for me in reality? How is my flip going on a budget versus actual standpoint? And what are my pain points and what cost me more money? Did it go longer than it should have? All of those types of things to really understand how you can improve as an investor and how you can make more money, especially when it comes to reanalyzing some of these properties, because, the way things are going, things we're reassessing in value every quarter, in certain cases. And so, and rents are rising. And so you want to be able to take advantage of that and say, when can I refinance? When should I sell? Where are we at in the market? All of those things are extremely important that maybe it's too much for the average person to initially take on, but having some basics that they really know their personal financial situation, have right reserves, and really know what their personal budget is and what their goal is, right? What are they trying to do? They're trying to cover their monthly expenses with cash flow. So put that aside. If you make $300 on a deal, be like, great, I don't have to pay my cell phone bill for the rest of my life, or my utility bill. So, and it's interesting when you start thinking with that mindset.
Absolutely. And in a previous episode, I had one called, Scale Up Your Life. And it's all around the idea of having systems in place, having a methodical way to, organize your financials, to understand how you're spending, where you're spending. And you couple that, right, with the idea of to be able to do real estate well, I think business well, really anything in life well, you have to be able to execute, right? And execute well, right? So it's interesting because I'll meet people who want to get into flipping, and it's like, well, have you ever, built anything or lifted a hammer in your life, right? Or I'll talk to these new investors and like, well, I want to get started, but I don't know if I should buy a 4-unit, 8-unit. I'm like, well, why don't you just buy 1 unit and figure out some things? So on that point, because I learned 2 things. I mean, really, if I were to do it again, I'd be curious to get your thoughts on this. Grant Cardone, as ridiculous as he is in a lot of ways, his book's not bad. His real estate book, and he says in there, if he were to do it again, he would buy big, then versus buying small and working his way up. I think you probably should learn the lessons first, but now knowing what I know, if I were to do another multifamily unit building, I would do a bigger project, absolutely, right? And I would do it by buying a distressed asset and then fixing it up, increasing rents, and either holding it or then selling it. So I'd be curious to get your philosophy on that area of real estate. And if you were a new investor, do you think it's wise to start out with a 4-unit building?
So in my opinion, I think everyone should start off slow. It depends on their capital stack and what risk tolerance level they're comfortable with and how much renovation experience they have and things like that. So typically, the biggest difference between a single family and multifamily is, more renovation and more moving parts on that side and more potential issues that could come up on that piece. So if your renovation skills are really on point and your costs down on that, then you might feel more comfortable with a larger project or something along those lines. If it's turnkey and fully renovated, go get some advice from outside people on reviewing that cash flow and seeing what things they should look out for, and start with the education first and then pull that trigger. But don't get into the analysis paralysis, because in reality, you learn the most actually doing. I remember graduating and getting a CPA license and everything with, really no accounting experience coming out of college, until I worked for a CPA firm and doing it every day. And then you realize, okay, this is how it actually works in reality, So, and that same thing with real estate, right? When I say you learn 700 ways to lose money on a house doing that many houses, it's like, wow, this new thing came up. They cut the line to the utility company, and now I got to pay for it when they're putting their fence in. Or, like I was just telling you, the historical society won't let me, tear down my house. I got to wait another month for this. And it's all those thousands of little things that you got to maneuver through to learn. And so, taking your bite on maybe one renovation project on a single family house or something like that might be the ideal situation, because you have more exit strategies. You have better financing on the back end to take you out. You can counterbalance that risk with rents and things like that as well. And they require less down, even though in this kind of a market, you want to make sure your margin is good and that you use lower leverage to protect yourself from any downside risk. But, in reality, it's going to be a great time to buy and hold all of those types of assets. I like singles much. I love multifamily, but I hate the financing. It's because you can get a 30-year fixed at a 4% interest rate right now on a 30-year fixed for an investment property, and you don't have that interest rate volatility risk like you do in a multifamily when you got to go refinance in 5 to 10 years, because that's how commercial paper works. Sometimes you can get 30-year fixed on big stuff, but and fourplexes are great because you can still get the financing, but you're probably going to put more money down because there's less comps. Appraisals aren't usually the best on those.
Not at all.
You also need to make sure all systems for all of the units are really in good shape long term, so that you're not caught with CapEx, expenses, an AC unit, a roof, plumbing, electrical, appliances. Know your useful lives of all those items so that you know what your real cash flow is and know what your real investment is. Because if your roof has 3 years of useful life, don't you think you should put that money aside up front just in case it goes by on year 2 or year 1, So.
Yeah, it's interesting too. My first fourplex taught me a lot, right? And it's just a more complex equation because there are naturally just more variables, right? The roof is bigger. You might have, even though it qualifies as a 4-unit residential loan, it might qualify as a commercial within the council or the city council. So your codes locally, for example, I learned the hard way. I bought a fourplex, I did a house hack and I was like, oh, nice. I get a nice residential loan. But then I still qualified under a commercial property because with the county, 4 units was commercial. So I was like, okay, I didn't know that. So I had all these different codes with, to your point, I had to add a 5th meter for the building, because there was one light outside. The roof had a different code. I had to use a unique rubber roof that was way more expensive than an ordinary, asphalt or shingle roof.
Right.
And all these, like just driveway codes and everything else. It's just a different beast. And until I think you understand how general plumbing works, how general ampage and just electricity works, how to do tiling, and painting. If you don't know those basics, buying a multi-unit building, I just think it's a big elephant for you to take on for your first one.
Yeah, I agree. And really, like I was saying, learning that renovation piece is key to real estate, because you will get stolen from by contractors. You will have problems with jobs that you don't know how to handle. And so if you don't have that, you better have somebody on your team that really knows that in detail, that's reliable. And I always have somebody outside of the contractor managing the contractor, and that person always has renovation experience, because if they don't, there's like punch lists of items that never get done, or something major that gets done the wrong way that costs you a lot of money. So it's little things like that, because contractors really don't, even though they know how to repair the items, they don't necessarily know what you want as far as longevity on an asset like that, you know?
Yep. And two things. So what Matt just used was the term punch list. And until you're actually using that in your actual verbiage, you probably shouldn't be doing rehabs. So, but then I'll tell you one other thing. So I have this friend, well, now a friend, he owns his own, electrician company. And he's one of the better ones in Cleveland, Ohio. He's a premium price. And I asked him, and his name's Cruz. I was like, Cruz, I've seen your bids. They're outrageous. He's like, yeah. What's funny is I'll give out these bids to people on their projects, and they are outrageous. And I'll only get 1 out of 3, offers accepted. But the point is, my margins are 4 times the offer, or like my usual case. So I can do 3 jobs for lower margins, or I can just do one big one for someone who doesn't know what they're doing. And it's like, so, and I know it's a bit sketchy, but it's like, it's not just him, it's my plumbers, it's my
everybody
roofers,
does it.
They're all doing it. Right.
And they're in massive demand right now. So
huge, and one of the problems, and I don't want to digress too much, but for years, our system has kind of almost looked down upon those industries. Right. And if you look at where the funding's going for post high school education, 95% of it is towards college. Only 5% is towards the voc tech, occupations. So there's just a natural, shortage in supply of these workers. Naturally, why you're seeing them. I mean, my plumber, he's not even licensed. He's making $125 an hour, right? My electrician's making $160. Who is licensed? That is lawyer money. Like they're doing really well.
Yeah, it's really interesting, and it's going to get worse. I mean, there's a big lack of supply of electricians and plumbers and HVAC people, and it's probably a great idea to start training those types of people and 100%. Putting programs in place to do that, so that you have viable workforce in that area, because it's just not there. They're going to be making more than the college person, especially if they go get a degree in like communications or whatever,
engineering,
right. I mean, look, college is great to grow up, but it doesn't teach you about how to make money, so at the end of the day,
not at all. It'll be interesting. And just one last thing I heard on that is that basically the idea of like, well, we'll just outsource it to AI or something. Well, apparently each job is so complex and there's over 10,000 different variables that are always changing that it will likely be the last industry that AI replaces. So it's just a fascinating place to be. And I guess what we're trying to say is just know a little bit what you're doing before you get into the bigger messes. So
right, for sure.
I want to pivot a little bit because you're doing a lot of great things in terms of raising money, your debt fund and everything else. Could you give us a little high level summary of what you're doing there? How much money are you managing today, and what's your next 3 years look like?
So over the last 14 years, I've basically raised over $75 million from different investors and clients, and utilize it in a lot of different ways, from a buy and hold portfolio that we deal with, from our debt fund that we're lending capital out of, from our own internal flips that we do ourselves and things like that as well. And then our multifamily projects too. And then we fund ourselves a lot of smaller projects and second position liens and things like that on projects to get things completed. And so, from that perspective, it depends. The investment raised, so when you're trying to raise money from a client, really depends on the risk tolerance of that person, how they're investing in the project, how long the term is of that project, because a lot of people, it's understanding what they are comfortable with. A lot of my investors, I put short-term type things, put them in short-term type notes. And so they're very comfortable with that type of structure because I've taught them how we protect them. I've taught them how the paperwork works. And I've taught them how our leverage works and where the risks lie on the investment. And I've also covered them in certain cases, and in pretty much all cases where if there was losses or a loss of revenue or something occurred on a project, which is very rare, but at the same time, I know I joke and say 700 ways to lose money, but at the same time, it's like 5% of the projects will break even or something along that, or have a slight loss or nothing major. But at the same time, I protect my investors and show them and teach them how to mitigate the risks on these projects. And so like if I'm raising in my debt fund, I have a 2-year type term that I deal with. If I'm raising for a multifamily, they understand that it might be a longer term until we refinance. And I structure it with preferred returns so that my investors get paid before I do, so that I'm putting my money where my mouth is. And I also invest my own money in all of these types of opportunities too. So by doing that, and also over a period of time of doing what you say you're going to do every time, being on the money when it comes to accounting and getting payments out to them and paperwork and all that kind of stuff, which is the most important thing to protect your client and make sure they're, your investor, and make sure they're, on board with you and comfortable with you, and really focusing a lot on education. Those aspects are the most important pieces of raising capital, so.
Yeah, in fact, I would agree. I mean, when I look at my side, I actually have not raised capital for big projects. I do, individual flips for all my teams. Mm-hmm. And it's interesting, right? Because I'll meet a client. They're like, I love the way that you look at your deals, and you have good returns. We offer 10 and 2 to our team in Cleveland, and then we offer 11 and 3 to our other teams. So the 10 and 2 is because it's the guy who's the doctor. He's so meticulous that it's like. Right. The risk is so small that the most I can potentially squeeze is 10%. Anyways, so I think you're spot on. It is the communication, the transparency, the consistency. It's all essentially things that they can see patterns of trust and integrity, because at the end of the day, these people who are putting $70,000, $80,000, $100,000 or more, that's hard earned money, right? And they don't want to lose it. So. It's interesting because like they do this crawl, walk, run approach. They start one, like, oh, this is great, I'll do 2. And like, you know what? How much can I give you?
Right. It's it's important to realize that when you're utilizing your investors' capital, they traded hours of their life for that money. Yeah. So like, and being able to understand that gives it a lot more respect when you realize it's not just money, it's someone's life that you're, it's time. It's time, which is everything. Right. So, and it's crazy when you have that kind of respect for it. I would literally lose all of my money before I let my investors lose their money. So, and it's a crazy thing to say, and it's scary, but I know how to make it back. If that's the case, a lot of them are trading time for money. I can continue to build assets and that type of stuff and still have the experience that I have in the industry to move that forward, but it's, there's so many moving parts and new ways of making money in this industry that there's a lot of ways to implement that capital to protect it. And a lot of people can diversify. When I'm dealing with my own investments, I put some money into promissory notes. I put some money into syndicated investments that are also diversified with different operators in different markets of the country and different asset classes. And then I have some in my flips, some in my holds, and it's all about developing cash flow streams in different ways so that I don't have to constantly trade my time for money, so, and active flips can be very, very, even holds and reviewing all this stuff obviously can be active, but it's a matter of growing to the point where you put someone else in place to do those types of activities for you, to give you reports, which is really, you want reports on the beach is the whole goal with all of this, right? So
I mean, I don't know how it'll sound. It's almost, that dream of mine is to be reading financials on a beach. I mean, that's ridiculous.
On your phone.
Yeah, I don't think I'll ever not want to be doing that. I just love, actually, it's kind of random. One of my most recent projects, and I'll just fill you in. I was getting my haircut the other day, and my barber was complaining about his the owner. I'm like, well, where is the owner? He's like, oh, he's never here. I'm like, he's never here. Like, does he cut hair? He's like, no, never in his life. I'm like, all right, hold on, fill me in on this. How's this working? So he breaks down the numbers, and what I realize is that barbershops are essentially a pseudo real estate model. Right. So I'm now looking into opening up a barbershop. So
you're gonna sublease it, and
that's what it is. Yeah. So you sublease each chair, and you're essentially a landlord. And then you have, to your point, you have one person managing the shop and the service. Mm-hmm. So there is a personnel aspect to it, but it's
a matter of a marketing campaign to keep those chairs full and rented the whole time.
Right. And what's amazing is that with Yelp these days, like, location has a lot less impact versus what it once had. Right. So.
Right.
Well, hey, I appreciate everything that we've been talking about. Where can people find you if they want to ask questions? Do you have openings if investors want to give money? What's that process look like?
Yeah, so you can find us at ocgproperties.com and email us that way, or send us a message through that, or you can email me at invest@ocgproperties.com. People invest with me with a number of different ways, through buying assets, through investing in our funds, and doing all types of different stuff. And so I typically sit down with people and go over their financial situation and help them understand what options are available to them, and based on their goals, tax mitigation strategies, 1031 exchange strategies, all that type of stuff, and just kind of help them. But yeah, if you could email me at invest@ocgproperties.com, I'd love to help people. That's pretty much what we do. And you can go to forinvestorsbyinvestors.org also and find all of our different Phoebe chapters for more education. I'm sure we'll have you on soon as well. So
awesome. Yeah, and I'll put all this in the summary of the YouTube video, and anything that I get from anyone, I'll be sure to forward your way.
Cool.
When I slow it down,